Okay, welcome back. Now we're going to hear from Taylor St. Germain. Taylor is with ITR Economics. He's going to give us an economic outlook for us to get some, knowledge about where things are going. And I think it's a great presentation given the recent election and, the uncertainty in our economy right now. So we're going to hear from Taylor. Again, please make sure to ask questions in the question box as we go along, and Taylor will join us after the presentation to answer those questions. So let's get started.
Hi, everyone. Thanks so much for having me here today. My name is Taylor St. Germain. I'm a speaker and analyst from ITR Economics. For those of you that don't know much about ITR Economics, we have been around since 1948. We're one of the longest privately held economics firms in the country. A man named Chapin Hoskins founded our organization in 1948. He was upset nobody saw the Great Depression coming. So he utilized the business cycle methodology that we still utilize here today. Our president and CEO, Brian and Alan Bolio, have been at the helm of the company for over 30 years now. So we've been in the game for quite some time. Before we get started today, I wanted to sort of give you all a lay of the land. The title of my presentation today and what you'll be hearing about is some of the uncertainty that's out in the economy right now. I'm hoping I can make this a more certain economy for you as we look out over the next few years. So that's really my goal today. I wanted to start by showing you the summary of my presentation here today and what we'll be talking about. So, of course, I want to talk about the major U.S. forecast, the U.S. GDP forecast, industrial production, but I did also want to show you some of the global trends that we're seeing out there over these next few years. I do want to touch on current events. Those current events will be COVID-19. And the reason I really want to discuss COVID-19 is just to make you all aware of the assumptions that we have built into our forecasting models. We'll, of course, talk about the election for at least what we can talk about so far. I know there's still a little bit of uncertainty there, but I'll give you our general perspective on the election and then talk about some business bankruptcies, some unemployment numbers, things that we're all concerned about. That'll be the first portion of the presentation. Then the latter half of the presentation will really dial in on the construction markets here in the U.S., some of the trends that are specific and important to all of you. And then we'll finish off talking about people and finally our long-term expectation for this next decade. For those of you that have followed ITR in the past, you're probably very aware of a 2030 Great Depression that we've been calling for. I wanted to give you a brief update on that. I think we've had enough bad news in 2020, so I'll try to keep that section short, but I'm sure it's something that you're all interested in. So I'll finish off the presentation discussing that today. So I don't want to waste any time. I really want to jump right into things here, and where I want to start today is looking at COVID-19. I'll show you cases, I'll show you deaths, but again, really what's important to me is that you understand the assumptions that we're making in our forecasting models. So what you're looking at on the screen right now is daily cases of COVID-19 in terms of thousands, so number of cases per day. You can see that in the most recent, especially few days, we have hit some new record highs in terms of daily case figures as it relates to COVID-19. We saw a general improvement coming out of the initial inception of COVID-19, then a pretty big jump in the third quarter, and you can see why there's a lot of concern out there related to COVID-19. Of course, we just got news earlier this week that there is a potential vaccine on our way, which the stock market was very happy to see for at least Monday, before Tuesday was a little worse than we were all hoping to be from a stock market perspective. But in general, there is some positive developments related to the vaccines in COVID-19, and we think that's a real upside for next year. But that doesn't downplay the concerns related to cases right now. And we do understand these concerns, and we don't ignore these concerns. But I want you to be critical of the case data. I think we all are here in the United States. There's some concerns about the reporting. There's concerns about the collection and of the data. So I just want to, again, I think it's a metric we all need to be very aware of. And I want you all to understand that we don't see COVID-19 itself, the pandemic, as the economic impact. Really, where the economic impact comes from is the decisions governors make whether or not to reopen their state at this point or reverse some of that reopening strategy and that reopening process. So again, it's concerning to see cases this high, but really where we come in is trying to understand some of the decisions the governors will make in terms of shutting that state down. And if you look at cases are quite elevated right now, but if you look at the death perspective here in the US, so this is deaths per day related to COVID-19, you'll notice it's almost the opposite trend where initially we saw some very high death numbers, but that has been generally improving over time. I think even as my heartless, emotionless economist self, I have to tip my hat to some of the medical professionals here in the United States for understanding the virus at a much higher degree and treating it, and that's contributing to a much lower mortality rate. So from a death perspective, again, there's still people dying in the United States as a result of COVID-19, and that is certainly not what any of us want here in the US. But we are making progress in terms of deaths from where we originally saw back in that March, April, May timeframe. So again, we can stare at this data, debate, argue COVID-19 data as much as we want, but really what it comes down to from the economic perspective is whether or not we're opening or shutting down the individual state economies here in the US. And if you look at this next chart here, you'll notice my legend in the bottom right-hand corner. It's looking at the number of, or the states that have reopened in dark blue or are in the reopening process in that lighter blue color. And then you can see the states that are pausing or reversing. You'll notice the vast majority of the United States is in the reopening process or has reopened in terms of their state economies. Now, there are some states that we're still concerned about. Of course, you can see California, New Mexico, Idaho, Illinois, New York. Some states that do have a pretty significant impact on the overall GDP figure here in the United States. However, the reversing strategy in these states isn't what it was back in that April, May timeframe. It's really looking at limiting large social gatherings, restaurants, bars, some movie theaters. So it's not the full economic shutdown we saw back in that March, April, May timeframe, but there still is some hesitancy among some of these states. But again, what's important is the assumption we're making in our forecast. And in the forecast I show you today, we are not assuming a second economic shutdown at this time here in the United States. Based on the progress that we have seen around the country, we do anticipate as we move into 2021, we do continue to see progress in terms of the US opening in a greater capacity. So the flip side to that is, if we do see a second economic shutdown, that is a downside risk to our forecast. And again, I want you to view that as the case here today. Meaning, if we do see a full-fledged second economic shutdown, it's likely that we have to revise these numbers lower. But based on the progress we've been making over the last few months and the rhetoric we hear from politicians and state governors, it's very unlikely we see a second economic shutdown like we did in that second quarter of this year. So again, we could talk COVID-19 for a very long time. I wanted to keep it relatively short because I think we're all well-versed in COVID-19 data at this point, but just wanted to make you aware of that assumption as it relates to our forecast. The last piece of information I wanted to share with you about COVID-19 is the accuracy of the models that are being put in place as it relates to the pandemic. And I have to give the Washington Post the credit for this research. They essentially, what the Washington Post did is they looked at previous pandemics that have worked their way through the United States and COVID-19, and the models that were put in place for these pandemics in terms of predicting how bad or how severe the pandemic will be. And what the Washington Post found was that the models that are being put in place are reliable, but only out about 4 weeks. So anything beyond a month, the Washington Post research has said it has been inaccurate or unreliable. And I wanted to share this with you because we hear a lot of concerns even about the first half of next year as it relates to COVID-19. And I just want you to be very critical of what you hear because, again, the research shows that the forecasting models as it relates to the pandemic just aren't accurate more than 4 weeks out. Now, this is not me taking a shot at the medical professionals. They have a variable that is very difficult to forecast, and that's human behavior, especially here in the United States as it relates to something like COVID-19. We can tell everybody the best practice in terms of mitigating the impact from the virus, but actually seeing people implement that process is not something that we always have control over. So it makes it very challenging to understand and predict what we're likely to see as a result of the pandemic. So that human behavior aspect, especially in a democracy like the U.S., makes it pretty challenging to forecast something like COVID-19. So again, just want you to be critical of anything that you see beyond 4-week expectation, because the research has just said that we need to be careful in putting all our eggs in that basket. Now, I wanted to move on to another major current event. That is the election. So this is what you're looking at here is U.S. real gross domestic product historically. You can see the GDP growth rate over time, or excuse me, that's the dollar value of GDP over time. And you can see overlaid in the background is the color of the presidential party and the president as well, who was at the helm here in the U.S. at the time. Now, we are an apolitical firm at ITR Economics. Our job isn't to share political opinions with you. Our job is to evaluate policy and forecast accordingly. So that's really the approach we take. I want to make sure that's very clear to all of you. But I want to make some points on this slide for you. First of all, U.S. GDP does not favor a political party. If you look at the average GDP growth since 1976, it's 2.85% under Democrats and 2.81% under Republicans. In the grand scheme of things, Republicans and Democrats are essentially growing the economy at the same rate historically. That's an overall GDP number. Now, that's not to say we don't recognize concerns moving forward. Obviously, the largest concern we had coming into this election season was that we would see some tax increases, which would likely result from a Biden presidency and a Senate that would flip to the Democrats. Based on the results that we have so far, it does seem, according to the Associated Press, that we will have a President Biden. And then, of course, we have that runoff situation in Georgia, with the experts saying that the Senate's likely to stay Republican. Now, again, we really have to see what comes to fruition before we go making any assumptions into the future. So really what I want to share with you today, though, is regardless of who's elected, we don't anticipate on changing the 2021 forecast. It takes time for new policy to develop, that legislation to pass through the different branches of government, and then actually see that legislation come to fruition and impact data. So we are looking out to 2022 and 2023 as it relates to some of this potential legislation, whether it's tax increases, environmental regulation, an infrastructure bill. Some positive, some would, the thought process would be take the wind out of the sail of the growth trend that we have forecasted further down the line. But again, it's really challenging until we see how the Senate election develops to look out that far and make adjustments to the forecast. So I'm telling you, we're evaluating legislation. 2021, regardless of the turnout of the election, is very unlikely to change due to that lag time before the policy actually starts to impact the data in our everyday lives. And I also wanted to let you know that on November 17th, our president and CEO are doing a webinar all about the election and research they've done into historical precedents as it relates to the election. So we will have much more information coming your way as it relates to the election. But again, 2021 forecast that I show you here today is very unlikely to change based on the result of this election. I know that's not the most fun answer, and I certainly understand that. I was myself hoping for a little more fun, but I think that's can give us all a chance to breathe a sigh of relief knowing that GDP historically really never favors a political party. A couple other current events that I wanted to touch on, and this will kind of tie in some of the election conversation, is the unemployment rate. The unemployment rate did spike pretty significantly in the pandemic. Of course, we had some record low unemployment numbers before the pandemic developed. Then we saw a significant increase as a result of the economic shutdown. you can see we're making progress now. That unemployment rate has fallen back down to 6.6%. The Federal Reserve Board is forecasting 5 to 5.5% next year, so general improvement in the unemployment rate. But where the politics side of thing comes in is when we discuss a potential second round of stimulus here in the United States. I think both the Democrats and Republicans understand that a second round of stimulus is needed. It seemed that that was a pretty consistent expectation before the election. But of course, the concern was, do we see a second round of stimulus before the election or not? Obviously, we did not see that second round of stimulus come to fruition. But we are expecting to see a second round of stimulus as we move later this year, and especially into the first half of next year. Now, that has an impact on the unemployment rate, of course. A lot of benefits. We had that $600 unemployment benefit in the previous round of stimulus. Now, I know for some of you out there, you felt that that was a misstep among the government, saying that $600 a week was too much for employees in terms of motivating them to come back to work, so they were actually making more money on unemployment. We've heard that anecdotally, but what the research tells us, and the research from some of the major job corporations here in the U.S. has said that that is actually not the case in terms of statistical significance. So again, I think we've all heard those stories or know people, though, that decided that they were making a bit more money on unemployment rather than going back to work. But nonetheless, that number of improving to 5 and 5.5% that the Federal Reserve Board is forecasting could be impacted by that second round of stimulus. So again, it seemed like the Republicans were offering a $400 unemployment benefit because they felt that was enough to provide some aid, but to also stimulate employees to go back to work. We'll have to see how that shapes up as it relates to some unemployment forecasts. But again, another assumption we're making is that we do see a second round of stimulus at this point. Again, it's just where are some of the concessions from the Republicans and Democrats in order to get that bill passed through. Another area that could be impacted as it relates to stimulus is U.S. business bankruptcies. This is the last sort of current event I wanted to share with you. There's a lot of concerns that because of the pandemic, we'll see a pretty significant increase in business bankruptcies. However, what you're seeing on this chart is so far we're doing okay. And we have data through the third quarter. This data comes out quarterly to us. And what you can see here is that bankruptcies are currently at 1.9 million in terms of bankruptcy filings here in the U.S. That is below the 10-year average, which is this blue line. So far, it seems that stimulus money has helped. And we're seeing bankruptcy filings remain quite low, like we have really seen throughout the last 5 years. So overall, good news from business bankruptcies at this point. Certainly not at that 5+ million mark that we saw during the financial crisis 10 years ago. Now, I know there's a real concern here as well as it relates to stimulus, and that's that we have some zombie corporations, as they're being called, that are essentially surviving off some of this stimulus money. But with some of that money working through the organization and essentially running out, we could see a significant increase in this number. I think it's another reason why organizations and individuals are concerned as it relates to how quickly we can get a second round of stimulus passed. I do think that it is likely if we don't pass a second round of stimulus in a timely manner, we could see an increase in this number. Just to highlight, in the second quarter, bankruptcy filings were at 1.8 million. They did increase to 1.9 million. Again, when you look at the overall trend here, not concerning, but we can see why it could be concerning in the future as it relates to a second round of stimulus. So we're watching these things. We're tracking them quarterly, monthly, weekly to make sure that our forecasts are considering all the necessary information. But again, I think that second round of stimulus is going to be important when we look at some of these metrics. So that's the current event information I wanted to share with you. I now wanted to, before we jump into the major U.S. forecast and sort of the lay of the land for the next few years, I wanted to give you a brief global perspective. Really just have 2 slides here that I wanted to show you. But I did want to let you know we are a global forecasting firm. We do forecast the different regions of the world, and we provide a forecast for the overall global economy. And that's what I wanted to show you here. Now, there's a few different lines on the chart. I'll explain them to you. That dark blue line that you're looking at in the background here, that's the 12/12 or the year-over-year growth rate for the global industrial economy. That's world industrial production. And it's a rate of change. So anything above 0 is growth. Anything below 0 signals contraction. So you can see with the most recent data point here, we are in a global recession right now. Probably not surprising to many of you, but the data is supporting that. If you look at our forecast for the global economy, that's represented by this dotted blue line. That's the upper and lower bound of our forecast range. You can see we have the bottom of the cycle in the fourth quarter of this year. So essentially in the quarter that we're in before we start to see general improvement as we work into 2021. You can see the first half of 2021 will be characterized by our recovery trend, but we do cross above that 0 line and move into accelerating growth as we look out into the second half of 2021. And I have the 2022 forecast charted for you here too, which again, you see the rate of change start to bend, but it's above 0. That's growth. It's just growth that'll start coming at a slightly slower pace as we move into the second half of 2022. So essentially, in the global economy, we are approaching that business cycle low. And then we have growth ahead of us for the next 2 years. And we utilize leading indicators to help us understand the directional movement of our forecast. And that's what you're seeing here in red. This red line is the G7 leading indicator. That's the group of 7. The 7 countries included in the G7 are the United States, Japan, Canada, Italy, the UK, France, and Germany. So all 7 of those countries are accounted for in that red line. You can see this G7 indicator has a 9-month lead time to the global economy. I've already made that shift on the chart. So I've shifted this indicator forward 9 months. It lines up these high points and low points, gives us a nice correlation between the 2 lines. And you can see this forward-looking indicator is supporting our improvement in 2021. So I wanted to show you how some of these leading indicators work. It's not just math and statistics behind the scenes, the regression modeling. That's not ITR. We utilize these business cycles and forward-looking leading indicators that have proved to be reliable in the past to help us understand what's coming our way moving forward. So we are expecting general improvement as we move into 21, and especially some very attractive levels of growth into 2022. If I wanted to show you some of the other regional leading indicators and show you that they are showing improvement as well. So it's not just that G7 leading indicator. We look at various indicators from various sources. And in this case, the sources of this information is the OECD. That's the Organization of Economic Cooperation and Development. There's 36 member countries in the OECD. And you can see based on some of their country-specific or region-specific indicators, we are seeing general improvement in all of the non-U.S. economic leading indicators. And you'll notice from my comment section to the right, all of these indicators reached a low point in either May or April and have been rising since then. So we are seeing improvement around the world in terms of the forward-looking economic metrics. Again, which I hope gives you confidence in 2021 truly being a much better year than 2020. I think logically we can make that connection. I keep hearing everyone say, I can't wait till 2020 is over. And from an economic standpoint, I think that saying holds true as well. Now, I do want to highlight the Eurozone leading indicator. It's still currently in rise, but it's one we're watching closely as a result of some of the shutdowns that we're seeing related to COVID-19 concerns in Europe. I showed you the U.S. death data earlier that we've been generally making improvement. That trend has reversed in Europe, where not only are cases rising, but we're also seeing deaths on the rise. So far, these leading metrics have not transitioned to decline and have us concerned about changing that forecast. But we will have to watch these next few months, especially as it relates to Europe and Canada, some of those areas that are seeing a pretty significant second uptick right now. So again, just wanted to start off with the lay of the land from a global perspective. I did want to make a comment about Canada for those of you that are tuning in from Canada or have a business application in Canada. I'm showing you the Canada industrial production figures. So the top 2 lines here are the rates of change that corresponds with the left axis. The bottom 2 lines here are the moving averages. In this case, it's more of a measure of volume in the industrial economy. If you'll notice, Canada has some further decline to go year over year based on our forecast. So we do think it's not until really the first half of 2021 where we see the low point in Canada and then some improvement in the data. I still want you to know that we expect Canada to improve in 2021 and finish 2021 in that recovery phase of the cycle. approaching that year-over-year growth in 2022 to finish in level at a growth level. So there's still positive news as we look out to 21 and 2022 in Canada. But I want you to notice this bottom line, and this is the trend that I really want to point out. If you look at our measure of the index value, so general volume or industrial activity in Canada, we do not expect Canada to return to the record levels that they saw back in 2018 and 19 coming out of the pandemic, at least for the next few years. So expect that we don't see that full recovery in Canada that we will see here in the United States and we will see in China. Now, Europe is very similar to Canada. We just, based on the decline that we've seen as a result of the pandemic, the oil and gas application for Canada especially, which has been hit very hard this year, we just think it's very unlikely that we'll see record levels coming out of these next few years. That trend is a bit different for the U.S., which I'll point out. We do have the U.S. making that full recovery and approaching record levels once again further down the line. So just wanted to show you that. Again, Canada will improve in 21 and 22, but the growth perspective might not be as attractive as what you see in other regions of the world. So now I wanted to move on to the United States. I wanted to start off first with everyone's favorite metric, U.S. GDP. What you're looking at on this chart is historical GDP performance. You can see each one of these dark blue bars represents a historical quarter's performance. So we had the financial crisis of 2008, 2009, followed by essentially a decade of economic expansion. But you'll notice in the first quarter of 2020, we started to feel some decline. In February, the U.S. officially went into a recession. But I'm sure the bar that stood out to all of you when I immediately flipped over to this slide was this second quarter. That second quarter was brutal for the United States. Of course, the pandemic being the largest impact through there. This first to second quarter percent change, just to provide some perspective, was the worst quarter-to-quarter percent change we've seen since the 1930 Depression. So that just goes to show how poor that second quarter was. But the great news was the third quarter came roaring back. And you can see that third quarter data came in quite positive, made up a lot of ground from the second quarter. And if you look at our forecast over these next few years, again, through the end of 2022, you see general improvement in U.S. GDP. Again, that highlights, similar to the global economy, we're at the low point of the business cycle. And we've actually already started the recovery trend from a GDP perspective. So some of the things we're urging our clients and organizations we work with to consider is, what are you doing to invest in this growth trend? We have growth for 21, 22, and give you some additional insight in 2023, that growth trend does continue. So after we turn this corner, which we really already have in the third quarter, we are planning for essentially 3 years of economic growth. So you should be asking yourself, what do we need to do as an organization to capitalize on these next few years of growth? That should be essential in your planning process right now. Is that you need additional capacity? That could be people, that could be space. Valuations for equipment are relatively low right now given the pain from the pandemic. Do you need to invest in new equipment? This is also a great time for M&A activity, where we work with a lot of private equity firms at ITR, and they are busier than ever because they see this exact trend coming their way. So those are the questions I really want you to focus on. The indicators are supporting a much better 2021 and even into 2022. What are you doing as an organization to gain market share, to increase those top line figures, especially after some of the pain we felt this year? So a lot to be excited about as we look at this U.S. economy out over the next few years. And the last thing I want to hear is that you were capacity constrained in 21 and 22 because you weren't prepared for the demand that was returning. The demand's coming. The indicators are supporting it. Make some of those decisions now so we can invest in future growth. Now, the story for the industrial side of the economy is slightly different, and that's what I wanted to share with you here. The industrial production expectation is very similar when we look at the trajectory to GDP, which is that in 21 and 22, we'll see growth trends. And I've actually highlighted our 2023 forecast on this chart, which shows growth. Again, just as a reminder, the top two lines are the rates of change, quarter over quarter and year over year growth rates. The bottom line is the index value, so that's our measure of volume in the economy. If you look at the US, it is similar to Canada from a timing perspective in terms of industrial production. We do expect that year over year, it takes slightly longer for the industrial economy to recover. That's because not only do we have the pandemic impact here, but we have the oil and gas impact as well. Some of you might remember 15 and 16 when oil and gas or oil prices specifically were below that $30 per barrel. That was a really tough time for the oil and gas industry. And of course, that has an impact on general manufacturing and some of the industries that are selling into oil and gas. And that was actually a time where the industrial economy felt a recession that GDP did not. So there are some nuances between industrial production and GDP. And if you'll notice here again, the recovery is just, we're not as optimistic that the recovery will take hold immediately like we're seeing in GDP. That will take slightly longer when we look at the year over year growth rate for industrial production. But again, as we look out and we prepare for 21, 22, 23, we are expecting growth figures for those years. You can see the 21, 22 forecast, very attractive levels of growth. So the messaging is the same. Understand the decisions you have to make in order to invest in this growth trend. And this is where I really wanted to highlight the difference between the US and Canada. When we looked at that index value for Canada, we did not have Canada returning above the 2018, 2019 levels. If you look at the US, we do expect the US to make that full recovery and return to record levels by the first half of 2023. Now, many of you might say, well, Taylor, that sounds great, but 3 years for the U.S. economy to fully recover seems like a long time, given where the U.S., of course. And I would point you back to 2008, 2009 on this chart. We had the financial crisis of 2008, 2009, and it actually took us more than 5 years to fully recover out of that recession. So this 3-year expectation is actually much more optimistic than what we've seen coming out of some of the previous recessions. And the reason we feel we can be more optimistic there is because this is just a fundamentally different recession than the financial crisis was in 2008, 2009. So many economic fundamentals are still strong and in place, and that was true throughout the pandemic. The consumer finds themselves in a better financial position, which I'll show you some of that data here shortly. The housing market here in the U.S. that really led the financial crisis is just expanding year over year with more growth in sight. The lending markets here in the U.S. are in a strong position and are willing to lend. So we have much more on our side coming out of this recession than we did in 2008, 2009. So once we can, especially with a potential vaccine coming our way, once we turn the corner out of the pandemic, we see a lot of these strong economic fundamentals to get us to record levels quicker than we did coming out of that recession 10 years ago. So again, we have growth on the way for the next 3 years. Make sure you're not ignoring that trend and you're investing in the future growth that we see here. I wanted to show you a similar leading indicator chart that I showed you for the global economy, which is, here's the U.S. leading indicators. You look at the U.S. leading indicators down the left-hand column here. The trend for every single one of them is showing rise. And again, if you look at the comments, most all of these indicators reached a low point between April and June, so in the second quarter of the year, and have been rising ever since. Now, we don't cherry pick the indicators that are just showing rise. This chart has remained the same throughout all of 2020. And if I were to show you this chart back in April, every single one of these indicators was in decline. If I showed you this chart in June, we had a bit of a mixed message. But it's a very consistent message now across the board where we've had multiple months of improvement in these forward-looking economic metrics. And that, again, I'm hoping gives you confidence in that forecast we have for 2021 being improvement. Again, it's not just a few areas of the leading indicators in the economy that we're seeing improvement. It's a very consistent story across the board. I did also want to touch on interest rates. We all like to talk about interest rates, especially when they're this low. I think we all enjoy that a little bit. But this is a fun chart. It's the Fed's dot plot. You've probably seen this before if you've been tracking and watching the Fed closely, have listened to some Chairman Powell's press conferences. He often refers to the dot plot. Each one of these dots represents a regional Fed chair and their expectation for interest rates in the corresponding year. Now, I will note this dot plot can change quick. So take this with a bit of a grain of salt, but in the general takeaway is interest rates are expected to remain quite low in 2020 through the remainder of this year and into 21 and 22. There's one brave individual out in 2022 that we can all see. But in general, interest rates are expected to remain quite low. Now, that's good news, especially for a country like the United States with the debt burden that we have. But for us as individuals at the business level, it's also great news. We have 3 years of growth coming, as you just saw me present in the previous slides. It's not a bad idea to borrow money in order to invest in that growth trend. Borrowing costs are very low right now. It's a relatively cheap thing to do. Using someone else's money to grow your business with interest rates at this level is certainly not a bad idea. And I know many of us found ourselves in some tough cash positions, tough financial positions as a result of the pandemic. So hopefully you're on good terms with your banker and you can take advantage of some of these low interest rates moving forward. Now, there is another important point that I want to make on this slide. If you look at the longer run, you can see that interest rates are expected to rise. Part of that expectation among these regional Fed chairs is there's a general expectation that as we look out, especially into the second half of this decade, that we are going to see inflation increase. That is something that we expect at ITR Economics as well. And many of you might be asking the question when we were covering the stimulus earlier, well, Taylor, what are some of the long-term impacts of the stimulus? And if that was a question you had, your concern or question is right on track. We have a lot of concerns as it relates to the amount of debt we are increasing here, or the debt increase here in the United States as it relates to our long-term expectation. Now, we can afford an interest payment on our debt, especially with interest rates this low. But that's more concerning as you look at the longer run. You see that interest rate creep up between 2 and 3%, and all of a sudden that interest payment on the debt for the United States just got more costly. And that actually feeds directly into that Great Depression 2030 expectation that we'll cover here shortly. But I wanted to show you that, yes, inflation is expected, especially as we move into the second half of the decade. And it is a concern of ours with the debt load, the increasing debt load as a result of the stimulus, and how costly that interest payment on our U.S. debt will be during that time. It is one of our drivers of that 2030 Great Depression. So good news in the near term. The stimulus is good news in the near term, but we're going to pay for it down the line. And that's why I wanted to share that 2030 thought with you here. But again, we'll get more into that as we progress through the presentation today. Directly related to that, let's talk about some near-term inflation. Looking at some of the commodity prices here. Copper, aluminum, zinc, steel is what's charted here. These are the quarter-over-quarter growth rates. So again, anything above zero signals the price is increasing. Anything below zero is prices below the year-ago level. Now, what you'll see here is regardless of where they're at in the relationship to the zero line, we are seeing cyclical rise out of all of these rates of change. You should anticipate a higher inflation economy or a higher inflation expectation in 2021. You can see that many of the commodities are already showing us that. It's very typical to see a higher inflation environment when the U.S. economy picks up steam. These commodity prices actually tend to serve as leading metrics for the general economy. So to see that rise in the commodity prices tells us that it's likely we see an increase in overall economic demand and activity. Now, as it relates to your pricing strategies, understand manufacturers are likely to be passing through price increases in 2021 due to these higher commodities. So you're going to need to evaluate accordingly your pricing strategy, but expect to see many more price increases than what we saw in 2020. Now, for those of you in steel, it still could be a relatively attractive time to lock in some of those costs, buy in bulk, but that's certainly not something you'd want to do in the case of copper. So certainly understand where your commodities are trending right now, but expect that we continue to see some increased levels of price inflation as we move into next year. The one that you didn't see charted on the previous chart is oil, and regardless if you're in oil, I have to share an oil slide being coming to you all from Texas. I don't know if I would be asked back in Texas if I didn't share at least one oil slide. So what I'm showing you here is oil prices are around that $40 per barrel mark. That is really where we've been trending over these last few months, and that's still much too low for new investment in acreage and drilling out there for oil and gas country. The Federal Reserve of Dallas releases an energy report that's available publicly. I urge you all to take a look at it. And they release that on a monthly basis. They're updating it monthly. And what they show is that in order to see new investment in terms of break-even points, most basins would require an oil price between $46 and $50 per barrel. And that's for investment in new drilling. Now, many of you might say, well, we're still pulling oil and gas out of the ground, Taylor, and that's true. For those existing wells that are in place, many organizations can operate at a much lower cost where that break-even point's between $20 and $30 per barrel. So we're certainly pulling oil out of the ground still, but we're not seeing that new investment, that new CapEx spend in oil and gas, and I think a big reason for that is likely the depressed price. But again, as we look into 2021, especially the second half of 2021, we do expect to see that oil price get into that high 40s, even potentially low 50s as we move later in the year, which will stimulate some higher levels of activity from oil and gas country. The last slide I wanted to end this big forecast section on is our manufacturing economy at a glance. This comes directly from our ITR Trends Report. It's a monthly publication. I'm sure many of you are familiar with it. This dashboard highlights our expectations for the various segments of the manufacturing industry. If you look out, this first column here is the current 12/12 growth rate. So this is the current year-over-year growth rate. The second column is year-end 2020 expectations. Then we have year-end 21 and 22 expectations. You'll notice the majority of 2020 is likely to be characterized in the red, which is our recession phase, finishing below the year-ago level. Again, probably not a surprise given the tough time the manufacturing economy has had with the pandemic. You'll notice there are some areas of opportunity: tech sector, computer and electronics, the defense industry. We expect to continue to expand as we look over these next 3 years. And then we do have some industrial machinery new orders. And I don't want this series to confuse you. This is actually machinery that is captured in more of the woodworking type market. So selling into some of those consumer markets rather than the industrial markets. So the name can be a bit confusing. But the reason you're seeing a very positive growth rate now and for the end of the year is because, like I said, the housing market and some of the consumer facing markets are still doing quite well. But again, as we look out to 21 and 22, you can see a lot of those very attractive growth rates are returning, finishing the majority of those years in the positive. Notice that we still do have a little bit of a lag in terms of oil and gas and aircraft, which again, given how severely they were impacted by the pandemic, not a surprise, but you can see we do have a pretty significant amount of improvement out further. So I wanted to move on to the construction section next. I know this is very important to all of you. I wanted to first start off with some of the residential markets. So looking at single unit housing starts, our benchmark for the single family market. Now this is starts. We'll look at existing home sales in a few slides. But if we look at single unit housing starts, very attractive trends when you look at the growth rates. The year-over-year growth rate, is currently at 8.1%. Quarter-over-quarter growth rate is 16.7%. Anytime the 3/12 or the quarter-over-quarter is above the 12/12, that tells us we have more year-over-year growth coming our way. It's what we call one of our ITR checking points. So you can see the housing market is just booming. We continued to see strong performance throughout the pandemic, acceleration in the housing market, a little bit of volatility quarter over quarter, but the trend is very much up when we look at the year-over-year growth rate, and you can see the quarter over quarter recovered quickly. So the housing market's doing very well on the back of a strong consumer, and we expect very attractive growth rates for the single-family housing market for 2020 and 2021. So more activity coming our way in terms of starts. If you look at this bottom number here, this is actually the number of units in millions. So you'll notice we are not building as many homes as we were before the financial crisis. That suggests we have a lot of demand still for single family homes, especially we have a millennial generation that's getting older and moving towards those peak earning years. I'm, of course, the millennial generation. We are not all living in our parents' basements, despite what some of you might think. And as the millennials do get older, we are expecting to see, again, more demand for that single family home space. But our population continues to increase here in the U.S. Well, I'll show you some population figures shortly. Our U.S. economy is getting bigger and bigger, and that supports more demand for single family homes. We think this is a great opportunity, not just in the near term, but throughout this next decade, really up until that 2030 timeframe. Because of the demand we're seeing for single family homes, we expect this to truly be a great market to be involved in over these next 10 years. And also a great equity building opportunity for those of you that are looking at investing in residential real estate. We do expect that price appreciation generally characterizes this next decade. So it's a great time to get into a house, especially with low mortgage rates. And we expect 5 to 8 years from now, you're going to be very happy with the equity that you build in your home. So always good to tie in the personal side here when we can. I wanted to show you some of the metrics here that are supporting a continued improvement in the single unit housing market. So single family rate of change, year-over-year growth rates here in orange. The National Association of Home Builders Market Index is here in blue. So that's the NAHB. They develop an index to essentially serve as a leading metric for the U.S. single family housing. And you can see historically great correlation. The NAHB did a great job with this indicator, and that indicator up 19.4% over the 8.1% growth of the single family housing market supports continued expansion like our forecast suggests. So again, very good news as we look at the single family housing market and some of the indicators. Another great indicator that I had just previously mentioned is mortgage rates. Mortgage rates are very low, and we can actually use the 30-year conventional mortgage rate as a leading economic metric. I want you to notice, again, single family starts, that same rate of change we've been looking at in the previous slides here in dark blue. This green line is the mortgage rate. It's an 11-month leading indicator. I want you to notice, though, that I inverted this axis here. So what this green line is actually showing is a declining mortgage rate. And as the mortgage rate declines, that's good news for single family housing. We've seen that historically. Again, makes logical sense. I'm sure you're probably saying, well, of course, that's good news, Taylor. But I think it's helpful to see that visually and how that has helped us understand historical movements in single family housing. Another metric that we have on our side is a low inventory rate. So that, again, single family housing starts in blue, year-over-year rate of change. We can see the inventory rate, which is again inverted on this axis. So this is showing a decline in inventories. And of course, a decline in inventories means there's demand for single family housing, and we need to continue to build more single family homes here in the US. So the metrics are on our side. And again, a lot different than 2008, 2009. For those of you that play in the housing market, if you're concerned about a potential 08, 09, we don't see it in the near term because of how favorable these trends are right now. So again, I really hope that gives you some confidence in a strong housing market as we move late this year and into next year. On the existing home sales front, we're not seeing the same robust growth in terms of year-over-year growth, but we are seeing general improvement, and especially as of late, quarter over quarter, you're seeing that improvement. And of course, with everybody sheltering in place the first half of this year, we did see a lot of movement in home sales. And this is also important for that remodel side of the economy. The remodeling activity has been really off the charts the first half of this decade, again, or the first half of this year. I think, again, with everybody sheltering in place, we're all staring at our homes and often thinking of the things that need to be fixed. So we're selling homes, we're doing a lot of remodeling, and there's a demand for a lot of building new residential housing. Very good news for the majority of the United States. And here's the delinquency rate for mortgage loans, and then we'll look at how the data is trending around the U.S. But again, for those of you that are concerned about a potential another housing crisis of 2008, 2009, we just don't see that in the metrics. When you look at the delinquency rate, again, a low number is good news. That means fewer of us are delinquent on our mortgages. You can see that number is quite low and has really just continued to improve coming out of the financial crisis. Here's the 10-year average, well below the 10-year average, nowhere near the 9% we saw in the financial crisis. Rock solid, as the title of the slide says so far from a financial mortgage perspective. If you're curious where some of this single-family growth is coming around the U.S., I wanted to highlight this chart for you. This is showing you current year-over-year growth rates for single-family permits here in the U.S. I wanted to show you where some of the areas of opportunity are for you if you find yourself as a national organization, can allocate resources to some areas that are more attractive, especially when you look at the southeast, south part of the United States. You can see a lot of double-digit numbers there. I'll really hit the point home as we move later in the presentation when we look at some of the associated costs of living in these areas. But there's generally a much lower cost of living as we look at the Southeast in that Texas, Oklahoma area. One of the reasons I love being here in Texas, and a lot of the population is coming to these states, is generally moving south from the Midwest, from New England, and moving inland from the West Coast because of how expensive it has got out there. And that correlates directly with what you're seeing in terms of some of the single-family housing growth. So a lot of this has to do with the cost of living and population trends, which I'll show you again as we move deeper into the presentation. There's a couple other metrics I wanted to show you here. If you look, I'm comparing U.S. single-family housing starts to U.S. household furniture production and kitchen cabinet production. You'll notice as of late, the housing market is continuing to expand, but we're seeing a pretty significant decline on the production side as it relates to some of this furniture and cabinet production. There's a few things at play here. The first is the pandemic created a very tough environment for a lot of these manufacturers to produce with the social distancing, the shelter in place. There's some challenges there. And then we also have some really high lumber prices here in the U.S. as a result of some of these capacity constraints. So there's a lot of things at play here, but it's really the disruption of the pandemic that has caused these two trends to diverge. Everyone still wants single-family homes, but some of these builders are getting more and more concerned as we approach 2021 that some of the furniture, some of the cabinets, even some of the electrical equipment that's needed to finish homes could delay some of their projects as a result of these figures being below the year-ago level. So there is still a concern out there with, again, some of the lumber mills. You saw production concerns. As a result, we see a very high lumber price. We see some of the production numbers down because of the results of the pandemic. So I don't want to highlight that there aren't concerns out there when we look at construction, the general contractors out there. They are, but it's not a demand concern. It's essentially, do the suppliers of the materials that are needed to finish homes, can they build capacity and take on the increasing demand as a result of the pandemic and the disruption? So I did want to highlight a potential risk that's out there. Another area I wanted to show you is single-family housing compared to millwork production. So in this case, we're not looking at starts, we're looking at permits, but it's essentially the same trend of accelerating growth. And typically when we see permits accelerating, we see millwork production accelerate. There was one time in 15 and 16 where that was not the case, and that was the manufacturing downturn. And given that the millwork series we're looking at is a production series, they felt some pain during that time. And again, that's also true during this time. We're seeing some manufacturing pain as a result of the pandemic. It's not as significant as what we just saw in the previous slide, but there still are concerns as it relates to the disruptions to manufacturing from the pandemic, and if these manufacturers can, again, bring on the additional capacity to make sure they are filling the needs of the strength that we're seeing out of the single-family market. I wanted to show you another one of these dashboards to essentially round out our construction conversation. I know we've done a lot of talking about the single family and multifamily housing, or the single family housing market, but I wanted to show you multifamily expectations. Still positive, but notice that we're expecting a slightly lower 2021 growth rate than, or 2022 growth rate than in the single family market. That's because we have high inventory levels in multifamily housing. We did see renters disproportionately impacted by the pandemic, so a little more concerned out there. But really what I want to bring your attention to here is the construction segments that are in the commercial space. You'll notice many of our commercial construction segments are below the year-ago level and are anticipated to be below the year-ago level, not just in 2020, but in 2021. The first reason for that is there's a natural lag time for the commercial construction industry. The commercial construction tends to fall behind single family and the general economy. If you remember back to 08, 09, that's when single family was impacted, but the commercial contractors were really impacted in 2010 and 2011. So there is a natural lag there, which contributes to some negative numbers, but also the pandemic is disproportionately impacting some of the commercial industries. I'm looking at office building construction, education, multi-tenant retail construction, manufacturing construction. Some of these construction industries are not expected to make a full recovery over these next few years as a result of what we've seen from the disruption from the pandemic. Again, when we think of office buildings and the working remote, when we think of multi-tenant retail construction and how hard the retail sector was hit by the pandemic, I'm sure this doesn't come as a surprise to you. But I did want to highlight there's still some areas of opportunity out there in the commercial space. And one that we're very excited about is private warehouse construction. We think the warehouse space will continue to expand throughout these next 3 years. And a big reason for that is the demand coming from e-commerce. So if you look at e-commerce, which is represented by this orange line here, e-commerce actually accelerated during the pandemic. 23.4% growth rate. That's a year-over-year growth rate. Just to highlight how crazy the pandemic was in terms of demand for e-commerce retail sales, again, with all of us sheltering in place. That is obviously much different from what we saw from overall retail sales, which essentially declined to the lowest growth rate since the financial crisis. So given all that demand from the e-commerce sector, we expect to see a lot of demand for warehouses. And that's because many of these e-commerce giants really, their competitive advantage is short delivery windows. And in order to have shorter delivery windows, they need more warehouse locations throughout the U.S. It's likely to be a significant area of opportunity moving forward. So the last two sections I wanted to share with you today with our last 20 minutes is people, and then finally finish off with that long-term view of the 2030s. I wanted to show you some trends. First, great news trend, which is a strong consumer. And it's actually a very unusual trend that we're seeing in consumer. What you're looking at is U.S. disposable income in terms of trillions of dollars. And you can see that during the pandemic, we actually saw the U.S. purchasing power, disposable income increase. That does not happen in recessions normally. But as a result of the shelter in place, we weren't traveling, going out to eat, spending some of that disposable income, we find a U.S. consumer that actually has more disposable income coming out of the pandemic than when they were going in, which again is a reason we're optimistic about a pretty attractive growth profile as we move out over these next few years. Just to highlight how unusual that truly is, I wanted to show you that from a cyclical standpoint. So show you how the rates of change for GDP and disposable income match up. If you notice, disposable income quarter over quarter rate of change is here in green. GDP quarter over quarter is here in dark blue. And typically they correlate very well with one another, especially in terms of directional movement. So look how fundamentally different this recession is from previous recessions. Consumer personal income spikes while GDP just falls off a cliff. So it just goes to show how different this recession is from previous recessions. And we have a consumer that's coming out of this recession much stronger despite what happened to overall economic growth. Another trend that's a good news consumer trend is the personal savings rate. The personal savings rate during the pandemic spiked significantly. Again, we didn't have some of those areas that we like to spend money on. We weren't able to as a result of sheltering in place and the uncertainty and concerns from the pandemic. And this, I will highlight that the personal savings rate is starting to come down, but it's still well below where we were going into this pandemic. So from a consumer standpoint, the consumer is still in a great position. Again, ties well into that single-family housing market performing the way it is. These next few charts are fun. I think they're fun, but they're also very insightful. It's understanding population growth and migration trends around the U.S. So what you're looking at on this chart is looking at net migration between states. We're still waiting for this year's census to be evaluated, but what we can tell you from the most recent year is that the majority of people are moving, again, to that south region of the country and moving to the areas out west that's everything but California. So anything but the dark red color, the dark red color, excuse me, is showing you more people leaving that state. That blue-green color is showing you more people moving to that state. Now, I want to be clear, this does not include immigration. This is just simply showing for those of us that already live here in the U.S., what states are we leaving, what states are we moving to? And again, if you think back to that permits chart that I showed you of the United States, you can very clearly see why the region here in the Southeast is so attractive, and Texas and Oklahoma were so attractive. Now, obviously, California is seeing a pretty significant migration away from the state. We all know that high cost of living, high taxes. You're seeing the states that are touching California benefit from the population trend leaving California. Now, maybe from a political standpoint, some of you will say, Taylor, we're not benefiting. That's a conversation for another day that I'm going to steer clear of. But nonetheless, all of those states around California are seeing some pretty significant growth in terms of the migration trends. What's really driving that is the cost of living. And this is the chart that I think will connect a lot of the slides that I've shared with you. If you look at this chart, each one of those figures in the states is looking at how much household income is needed to afford just an average home in that state. So you can see in California, that's quite costly. Hawaii is actually the only area that's more expensive than California. But again, this is an average number. For those of you tuning in from California, you might say, find me a house for that income level. If you look at the Bay Area and Orange County, I'm sure it's probably even 10 times higher than that figure. But you can see some of the population leaving California is starting to impact some of the cost of living in surrounding states. Now, Washington, given that big tech sector, it's not surprising to see the cost of living that high with the way some of the salaries are in that state. But you can see even areas like Idaho, Nevada, Utah starting to climb in terms of those figures. So again, it's so attractive for people to move to Texas. I actually moved down from New Hampshire to Texas, and you can see that's a $25,000 difference in the average income I would need to afford a home. And that's very attractive, and that's why you're seeing some of the population growth trends in the permit housing trends benefit from this. When we look at pure population growth, I wanted to show you this chart. So now we are including immigration. This is pure population growth. And no, I do not know how much of this is legal or illegal immigration. That question is not on the Census Bureau. It was voted down during the Trump administration as not being allowed on the census. So this is just pure population growth. This is looking at all people around the world. And what you can see here is that when we look at pure population growth, there are really only a few states that are not growing. Illinois is one of them. A lot of political concerns in Illinois, a lot of tax concerns in Illinois. West Virginia is another. What a beautiful state, but I don't know what's there other than the mountains and the beauty. So I guess that one makes a little more sense to me. But then you have Vermont. That's actually my home state. And earlier in 2019, they were offering $10,000 as a bonus just to move to Vermont. So they're struggling a little bit up there. And then Connecticut's the other one here, which has a pretty high cost of living. But again, you'll notice, where are the attractive areas of growth? It's some of the states surrounding California. It's Texas. And then you can see the southeast area of the United States. Utah actually comes in at number one. You know, some people like to say they have the Mormons, so they're cheating a little bit. But again, I think well, it's a great joke. We'll steer from that conversation today as well. But Texas comes in at number two. Very proud of Texas. A lot of businesses moving to Texas. And it's a great business environment. That's actually why we started a remote office for ITR down here. So again, when you look at some areas you'd like to expand into, make sure you're considering some of these population growth rates. But I also want you to be aware of another trend. Clearly, when we include immigration, the majority of the country is growing. you should expect to hire more immigrants in your business throughout this next decade. Maybe you want to tailor your hiring or retention strategies towards some of the immigration that's coming into the U.S. But do expect that we're hiring more immigrants throughout this next decade because they're driving a lot of the population growth here in the U.S. So finally today, with our last 15 minutes or so here, I wanted to finish off looking at the Great Depression and what some of our drivers are of the Great Depression of 2030. Now, I know this is probably a bit of a depressing thing, no pun intended, to talk about. And I understand that, but the reason we're showing you this is so that that doesn't have to be the case. We have about 10 years to prepare for this economic event that we believe is coming our way. And if we prepare accordingly, that depression could actually be a fantastic time for us. There's a lot of people who will not be prepared for that recession. There's a lot of people that will not be prepared. There's a lot of businesses that will not be prepared. If we take the right steps to prepare accordingly, this could be an incredible time for us. Think back to 2008, 2009. There were a lot of millionaires that came out of that financial crisis because they saw what was coming and were able to appropriately prepare. And as a result, during 2008, 2009, they were buying people's businesses for a much lower cost. They were buying equipment for a much lower cost. They were hiring people for a much lower wage. And so that benefited them throughout the next decade of growth. So we can take those same steps as we approach 2030. If we get our families, our businesses prepared for this, it can be a very prosperous time for us here in the United States. And that's why we want to share this expectation with you now. We saw 2008, 2009 coming, and we have several clients that are very thankful we saw that coming. But we wanted to put this on your radar even earlier than we did for 2008, 2009, because it seems so clear that we are headed in this direction at this point. So again, I really am showing you this. I understand it can be a slightly depressing thing to talk about in a year that's been slightly depressing, but I wanted to, again, highlight that this is a real area of opportunity, and I want you to look at this coming economic event just as that. But I wanted to show you some of the drivers of our thought process behind the 2030 Great Depression. We, first of all, look at government debt, and that's what I want to talk about on this first slide here. Each one of these lines is in billions of dollars, so as we get out into 4,000 billion, that's $4 trillion. This first red line is current transfer payments, Medicare, Medicaid, Social Security. That also captures the stimulus that has been injected into the economy. You'll notice that is the highest, the most costly payment that we have here in the U.S. is our transfer payments. This blue line here is current tax receipts. That's our government's income that we're making from taxes. So yes, for those of you that are very mathematically inclined, you already realize that we do not make enough money as a United States government to cover current transfer payments alone. So if we got rid of the bottom two lines on this chart and we simply just looked at transfer payments versus income, we don't have enough money to afford the amount that we're spending in transfer payments. Kind of the concept here in the US that we continue to spend but continue to cut taxes. So we're spending more but making less. That just exacerbates a federal debt situation. And then we have consumption expenditures and interest payments. Consumption expenditures here in orange, that's schools, post offices, the things we love and need to make this country as efficient as it is. And then interest payments on the U.S. debt. Remember, I talked about interest payments earlier when we looked at that Fed dot plot. Again, with interest payments low, the cost of the interest payment on the U.S. debt is starting to bend, is attractive. But you can see why I'm concerned about the long run when those interest rates are moving back up to 2 to 3%, according to the Fed. You're going to see that interest payment start to increase once again. So add this green line to the orange line to the red line, and that line would be off the chart. We are spending a lot more money than we're making here in the U.S., and it is that simple. Our debt situation is going to continue to get worse in the U.S., and this isn't even considering a potential second round of stimulus at this point. So again, stimulus, good news in the near term, will help stimulate near-term economic growth, but it's going to come at a cost down the line. When we look at federal, this was another slide that I wanted to highlight, the interest payment conversation. When we look at interest payments on the U.S. debt, you can see that here in blue. And again, that line is declining. U.S. government bond, long-term bond yields is here in red. When bond yields are declining, we generally see those interest rates declining, so that's good news for the near term. But again, you see that long-term interest rate expectation and why we're more concerned about this interest payment on the U.S. debt. And not to mention that level of debt will be much higher as we move into the second half of the decade for the reasons that you just saw in the previous chart. Now, one of my favorite solutions that's been proposed as of late is, well, let's just keep printing money, Taylor. Well, you're going to end up with an inflation number that is going to be something that we're going to have to contain if that's your solution. And the way that we contain inflation here in the United States is raising interest rates. So again, not really a solution to the problem there. Maybe near term, but going to create some pain in the long term. Now, I don't want to say there aren't other solutions to this. There are. We could raise taxes. Not very attractive here in the U.S. I think the majority of the United States, as shown by the 2016 election results, at least preferred some lower taxes. Or we could cut spending here in the United States, which is also not a very politically attractive thing to run on here in the United States. So because of our political environment here in the U.S., it's very unlikely that we're able to really reverse this trend in a meaningful way, which again is why we're pretty confident that we will see a major economic event like this as we move into the future. We're so near-term focused with our, especially our politicians here in the U.S., that it's very unlikely because of our political environment we'll really see any progress being made. When you look at the federal government debt per capita too, it's also at a record high. So we have an accelerating trend per capita when you look at U.S. federal government debt. That's $81,500 per capita. So again, it doesn't really, you can look at this debt trend any way you like. It's a concerning trend, and it's one of the major drivers, along with that inflation and interest rate expectation as we move later in the decade. I did also want to, before I jump over to the next slide, I wanted to touch on a few more reasons for the 2030 Great Depression. We expect that demographics play a very big role in that 2030 Great Depression, especially as it relates to those transfer payments, Medicare, Medicaid, Social Security. We expect those costs to increase significantly as we look at this next decade. The reason for that is the baby boomer generation here in the United States. Baby boomers, massive generation here in the U.S. And what many people fail to realize that the majority of your healthcare costs typically come in the last 2 years of your life. So as the baby boomers get older, they're already at the retirement age. As they move into those later years of life, they're going to see a significant increase in healthcare costs. They'll also continue to draw on Social Security. That will increase those costs significantly. The Congressional Budget Office reported in 2018, 57% of all of our spending in the U.S. was just interest payments on the debt, healthcare, and Social Security. So those three areas alone consumed 57% of all federal spending in 2018. The Congressional Budget Office expects by 2030, that number jumps to 70%. So I'll say that again, by 2030, 70% of all spending in the United States is expected to be just interest payments on the debt, healthcare, and Social Security. And that, again, is a big reason for that is the baby boomer generation. The solution that we always laugh at the most, and it comes from our CEO, is we could just have a war among everyone 65 and older, start in Naples, Florida, and work your way west. That'll take care of the baby boomer issue. Now, the reason we joke about this and we make a joke like that regarding a solution is, again, because of our political environment, we really don't see legislation that is going to be impactful enough, I guess, to really move the needle and adjust that 2030 expectation for us. But I want to let you know, this isn't just the United States. This is China. This is Japan. They have the same baby boomer generations generally that we do here in the U.S. Japan, the favorite statistic we like to share, and we've shared in previous presentations, I believe it was 2018 was the first time adult diapers outsold baby diapers in Japan, just to put in perspective how old the population in Japan is. China had a one-child policy. As a result, their birth rates are very low. They have a lot of men running around the country, and the supply of women isn't enough to create a much more attractive birth rate. And we see similar trends in Europe. Germany's an example of a large baby boomer population as well. And they have recognized that they have an issue with birth rates and replacing that population. So Germany has looked at immigration programs to usher in a younger group of immigrants to offset some of the older generation. But my point here is this is a global phenomenon that we're expecting for 2030. This isn't just an individual country's scenario. And we actually think the U.S. is going to come out of 2030 in better shape than many of the countries. And the reason is that pesky millennial generation that we have. My generation, the generation of millennials, is a massive generation here in the U.S. Gen Z, right behind us, is also a very large generation. So while I feel like us millennials are often at the brunt of the criticism, we'll all be very thankful that we have a millennial generation of this size, because it'll help us recover coming out of 2030 in better shape than some of the other countries around the world. So those are some of the drivers of the Great Depression. Our president and CEO wrote a book called Prosperity in the Age of Decline. It's all about this expectation. I urge you to check that book out. It's a fun read, I guess as fun as Doomsday can be, but it's really insightful. It gives suggestions on markets to look towards that are still likely to grow, areas to position your business, and most importantly, how to prepare yourself and your families, which I will touch on in just a second. But I know I just talked again about a lot of depressing things regarding the Depression. I, again, want to highlight the roadmap for these next 10 years. We have a lot of good news in front of us for the next 10 years. We expect that the trend in the U.S. is up throughout the next 10 years when we look at economic expansion. But that will lead up to the 2030 Great Depression. And what I'm actually showing you on this chart is the 1920s and the 1930s. If you remember the 1920s, we actually had 3 recessions. So we called it the Roaring 20s because, again, the trend was up throughout that entire time, but we still did have our blips along the way. We're expecting a very similar roadmap for the 2020s and 2030s, which is why I wanted to share this slide with you. Again, we'll have our bumps in the road along the way. We had a big one just like we did in 1920 to start this decade. And we do anticipate, as we look out to 2025, 2026, there is likely another bump in the road, but the trend this decade will be up. We have time to prepare ourselves for the Great Depression. We have time to enjoy an attractive U.S. equity market, an attractive U.S. single-family market, and overall attractive U.S. economic growth throughout these next 10 years. But make sure you're capitalizing on that growth and put yourself in a strong cash position as we see the 2030s start to approach, where we expect to see a Great Depression that is of the magnitude of what we saw in the 1930s. So what are some of the things to tell the kids? This is always one of the questions that we receive. Live below their means, especially as we approach the second half of this decade. Learning a second language is great. Our CEO says French is a good idea with the development in Africa. Our president says that Spanish isn't a bad idea with the Spanish and Latino population moving into the United States. Think about diversified income streams. If your spouse is in manufacturing, maybe construction is a good idea. Just think about diversifying those income streams. Look at those careers that are oriented towards the opportunities. Another way to say that, look at the careers that will not be automated in the future. I think that's another way that we have to look at that. Being out of debt by 2030 is important. Another reason why, if you're considering buying a home, it's best to do that sooner than later. You want to be away from that mortgage when when the depression comes our way, and be out of as much debt as you generally can as possible, especially from a business perspective. Be ready, have that liquidity on hand for the low point of the depression. We saw many people, again, who were cash heavy going into 2008, 2009. Even if you don't time the low point of that cycle perfectly, you are still putting money near the low like people did in 08, 09. We saw multiple millionaires come out of 2008, 2009 just because they were cash heavy and ready to buy at the low point of the cycle. That can be stock market investments, that can be investing in businesses, people, equipment, and again, be ready for the low point of the depression. The depression can be a fantastic wealth creation opportunity for us that are prepared. And finally, make sure you're self-reliant. That's always very important, I believe, but especially as we look out over this next decade. So I know that was a lot coming at you all today. I wanted to let you know we are constantly giving updates on these current events, our 2030 topic. Well, we have trends talks that are available on your various podcast platforms. They're very short videos. We won't make you listen to a 60-minute podcast about economics. We know that can be challenging, but we do have short 5 to 7 minute videos highlighting some of the current events and decisions that we're faced with today. So those typically come out on a weekly basis. And again, we're blogging, posting about these on the various social media networks. So make sure that you're following us there. You saw the ITR trends report. You saw some of our leading indicators. If we can help you in any way, identifying leading indicators for your business, showing you more of the trends report, please just reach out to us. I'm happy to help. We have a team that's happy to help. We know this is a very challenging year, and we certainly want to be there to help where we can. So I appreciate you all having me and listening in here today. I think this information is more timely now than ever, and I hope you got a lot out of that. I look forward to 2021 in the next few years. I certainly hope you do as well, and I'm happy to take any questions that you have for me at this point.
Okay, that was a lot of information. Again, please add some questions to the question area. Taylor is going to join us now.
Hi, Amy, can you hear me okay?
I can hear you, Taylor. Can you hear me okay?
Yes, I can.
Great. It's funny because we taped that just not even a week ago, and some things have already shifted a little bit, I noticed.
Yeah, especially with politics, there's never a dull moment.
Right. Yeah. But I think most of what you were forecasting still is very relevant for our members. So thank you for that. We do have one question from Phil. He says the banking industry is supporting small business through payment deferrals, etc. At some point, the banking community will no longer be able to do that. Do you anticipate specific assistance to industries like hotels, etc.?
It's a great question, Phil, and it is certainly a concern. From what I understand, of course, the Main Street lending program, that $600 million that was available, is really only a small fraction of that is being utilized. So there's the criticism of that program in the banking industry right now is some of those funds still remain idle while the hotel industry is essentially on the brink of collapse. Now, what I've heard in terms of aid for the hotel industry actually came from a Democratic and Republican senator. They drafted a bill that's called the Hospitality and Commerce Job Recovery Act. That was drafted in October. And what that bill does is essentially provides tax credit for the hotel industry in terms of a convention tax credit. So essentially, if you host a convention between 2021 and 2023, there would be a tax credit. So the thought there is incentivizing people to hold conventions once again, once the pandemic's behind us. Now, that's just a bill that has been proposed. I haven't heard of anything in terms of direct relief saying, in a stimulus bill, here's $500 million for the industry. Instead, it's come as a means of a tax credit based on what I've seen. From my understanding, that has not been passed. And so I think that will be a conversation that continues to develop in the second round of this stimulus program or the stimulus bill that we expect to be coming our way. But at this point, it's really just looking at tax credits for the industry. I have not seen anything more specific regarding funding in terms of a dollar amount to the industry.
Okay, that makes sense. Great. Steve wants to know which U.S. economic sectors do you think will perform the best over the next 3 years?
So sectors, I would say the housing market is certainly the big winner. We're forecasting even 19% growth for the end of the year next year, as I think I mentioned in the presentation. So that's a big winner. Another winner is the commercial construction sector, but the warehousing sector, not the sector as a whole. That there's a lot of opportunities there. In terms of manufacturing, we do see the majority of the manufacturing segments coming back. We see the medical industry, given our demographics, demographic trends really as an area of opportunity throughout this next decade. But the defense industry is also another industry that we expect to perform very well. No recessions expected over the next few years, and they actually didn't have a downturn this year. So those would be the areas that I'm focusing most on. Semiconductor is another really significant growing area out there that has performed even quite well during the pandemic. So those would be some of my thoughts on the construction side. Again, warehouse, single family housing. On the manufacturing side, defense, medical, semiconductor would be my thoughts.
Okay, great. Leon says, with inflation, what is the best thing to do to prepare for 2030? Will the value of money become drastically affected? And once one is out of debt, what are the next best steps to take?
Yeah, so as I mentioned, there still are places to put money when the economy collapses if you want to get a return, and that's Australian bonds, Swiss bonds, and Canadian bonds. Those are actually three of the financial markets that we're pinpointing in 2030 for ways to grow your money. But to his earlier point, we do expect inflation to rise and be very significant in the second half of that decade. So the thought is to get out of debt. Of course, you don't want to be holding on to a mortgage during a time like that. But then you're looking for areas to invest that money. So the idea is have a lot of liquidity before 2030 comes to fruition. So at the peak of that cycle, and let the economy spiral downward. And that's when you're going to want to use that liquidity that you have, that cash, whether that's buying businesses, buying equipment for your own business, injecting that money into the stock market. Those are some of the things that we want you to be thinking about as you pay off that debt and as you have liquid cash in your hand. But I want to be very clear. We still see the U.S. stock market as a great place for the next 10 years. We still are encouraging our clients to use interest rates and be in debt as we look at these next 5 years. There's our CEO often says that you're crazy to not be in debt with the growth profile that we have coming our way right now. So again, just it's a timing perspective. These next 10 years, don't worry so much about liquidity over the next 5 years based on our economic outlook. That liquidity really is going to have to come in the second half of the decade. And it's all about taking advantage of the businesses and markets and individuals that aren't going to be prepared for 2030. You're going to find yourself, whether it's putting that money in the stock market, buying a business, it's going to yield a significant return as we progress further into the 2030s.
Okay. All right. That makes sense. That is all of the questions I'm seeing here. I will share with our members how to follow your blog. I know that's a good place. Oh, wait, we do have one more. Oh, yeah, we just have a thank you. And get your updates. I get those regularly, and those are really helpful to see. So I will share that with our members, and we really appreciate you taking the time with us today, and great information. I think our members will find a lot of value in it, so we appreciate it.
Thanks so much. Really appreciate it.
All right. Thanks, Taylor.
Take care.
You too. Okay. Well, that rounds up our second day. I think that went great. I hope everybody enjoyed themselves. I hope that you found some value out of what we were able to present virtually. I know it's not quite as you wish it would be, walking through a plant and poking around a little bit, but hopefully you found some good value out of it. We will be sending a survey out, so please, very, very short, excuse me, please take the time to fill that out. Feedback helps us plan for future events. And if you have any questions, just let us know. Thank you.